Welcome back to the deep dive. Today, we're peeling back the layers on something that probably shows up on a lot of your paychecks, but maybe you haven't given it much thought. We're talking about the additional Medicare tax. Our goal here is simple. Cut through the IRS jargon, specifically from the 2024 instructions for Form 8959, and give you the essential takeaways. Think of it as, your quick guide.
Exactly. And what's really interesting, I think, is how this seemingly simple 0.9% tax gets pretty complex depending on where your income comes from and how you file your taxes.
Yeah.
So we'll dig into what it is, why it matters for your financial planning, and crucially, who actually needs to get that Form 8959 filed.
Okay, let's start right there. The basics. What is this additional Medicare tax?
Right. So at its heart, it's an extra tax, 0.9%. It's not the regular Medicare tax everyone pays. This one kicks in only when certain types of income go over specific threshold amounts. We're talking mainly about Medicare wages, self-employment income, and for some folks, RRTA compensation. That's Railroad Retirement Tax Act.
Oh, and a quick point. If you have a loss from self-employment, that doesn't count here. You don't get to subtract that loss when figuring this tax.
Gotcha. So these different income streams, wages, self-employment, do they just get added together to see if you hit the threshold?
Mostly, yes, but with a key difference. Your Medicare wages and your self-employment income, those are combined. You add them up and compare that total to the threshold. But RRTA compensation, that's treated totally separately. It has its own threshold, and you don't mix it with the others for that calculation. It's a really important separation. And another thing to keep in mind, looking ahead, these thresholds, they aren't indexed for inflation. They stay the same year after year. That's significant, isn't it? The not indexed for inflation part. Because over time, as incomes generally rise, even just with cost of living increases, more people could find themselves paying this tax, right? Without actually having more buying power.
That's exactly the implication, yeah. It suggests that, down the road, this tax could affect a wider group of people than it does now, purely because wages tend to go up. It's definitely something to factor into longer-term planning.
Right. Okay, so what are those thresholds currently? How much income triggers it based on filing status?
It breaks down like this. If you're married filing jointly, the magic number is $250,000. For married filing separately, it's much lower, $125,000. And then for single, head of household, or qualifying surviving spouse, it's $200,000.
Okay, pretty straightforward numbers there. So the million-dollar question then, how do you know if you need to file Form 8959? This feels like where people might get tripped up, especially if they have, say, a job and a side business.
You absolutely have to file Form 8959 if any one of these situations applies to you. There are 4 key triggers. 1, your Medicare wages and tips from a single job, just one W-2, are over $200,000. 2, same idea, but for RRTA. Your RRTA compensation from a single employer is over $200,000. 3, this is the combined one, your total Medicare wages and tips plus your self-employment income. And remember, if you're married filing jointly, that includes your spouse's income too, if that total is more than the threshold for your filing status, like the $250K or $200 we just mentioned. And 4, similar logic for RRTA. Your total RRTA compensation and tips, again, combined with your spouse's if filing jointly, goes over your filing status threshold. So notice, you could have 2 jobs, maybe each paying $150,000. Neither one hits that $200,000 individual trigger.
Right.
But if you're filing jointly, your combined $300,000 is well over the $250,000 threshold. So you need to file Form 8959. It's about the total picture for those combined scenarios.
Okay, that makes sense. It's not just about one big paycheck. So what about withholding? Does your employer just handle this automatically, or is it on you?
Well, yes and no. Your employer does have a responsibility here. They must start withholding that extra 0.9% additional Medicare tax on your wages, or RRTA pay, once they pay you more than $200,000 in a calendar year. They start withholding in the pay period you cross that $200K threshold with that specific employer, and they keep doing it for the rest of the year. But, and this is the really crucial part, they only base this on the wages they pay you.
Okay.
They don't know about your other jobs or your spouse's income or any side business you have. They also don't know your filing status. They just see their own payroll hitting $200. And you can't tell them to stop either if the withholding is required based on the wages they pay you.
So what happens if my employer does withhold it? Maybe because I earned over $200K from them, but when I combine everything and look at my filing status threshold, I don't actually owe it. Or maybe they withheld too much.
Great question. If that happens, you get it back, essentially. If you don't actually owe the tax or you owe less than what was withheld, you claim a credit for that withheld amount. You do that on Form 8959 when you file your tax return. So filing the form is still important, even if you think you overpaid, because that's how you reconcile it and potentially get that money credited back against your overall tax bill.
Okay, this seems like a good point to dive into those trickier situations you mentioned earlier, where things get a bit more complex, especially for people juggling W-2 income and self-employment income. What's the key rule there?
This is where it gets really nuanced, you're right. If you have both wage income, Medicare wages, and self-employment income, there's a specific interaction. The threshold amount for figuring the tax on your self-employment income gets reduced. It's lowered by the amount of your Medicare wages.
Oh, deuce. How does that work?
Okay, so let's say you're single. Your threshold is $200,000. If you also have $150,000 in wages, that $200,000 threshold for your self-employment income is reduced by that $150,000 in wages. So your effective threshold for the self-employment part becomes only $50,000, $200K, $150K. Any self-employment income above that $50,000 could be subject to the tax. Now, this reduction can't go below zero, but it can definitely lower that threshold significantly. And critically, this reduction rule only applies with Medicare wages. RRTA compensation does not reduce the threshold for self-employment income or vice versa. They stay separate.
Wow. Okay, that reduction rule sounds like something that could easily catch people by surprise. Could we walk through maybe a couple of those IRS examples? Seeing the numbers might really help make this clear.
Absolutely. Examples make it much easier to grasp. Let's take a look. All right, first up, Carl. He's a single filer. Carl earned $145,000 from self-employment and $130,000 in wages. Now, his wages, $130K, are under $200, so his employer didn't withhold any additional Medicare tax, no trigger there. But Carl's overall filing threshold as a single person is $200,000. Because he has those wages, we have to apply that reduction rule to his self-employment threshold. So take the $200,000 single threshold, subtract his $130,000 in wages. That leaves an effective threshold of $70,000 for his self-employment income. Since Carl made $145,000 from self-employment, which is more than $70,000, he owes the 0.9% tax on the difference. That's $145,000 minus $70,000, so he owes tax on $75,000. Carl must file Form 8959. This really shows how having both types of income can trigger the tax, even if neither income source alone seems high enough.
Yeah, that's a perfect illustration. He might have thought he was fine because the $130K was under $200. Okay, what's another scenario?
Let's look at Don. Don is married filing separately. He has $150,000 in self-employment income and $200,000 in wages. Again, his employer didn't withhold because his wages were exactly $200,000, not over. But Don's filing status threshold is only $125,000. Married filing separately. His $200,000 in wages are over that threshold. So he owes additional Medicare tax on $75,000 of his wages. 200K is minus 125K. Now for his self-employment income, because his wages, 200K, already exceed his filing threshold, 125K, the threshold reduction rule kicks in hard. His 125K threshold is reduced by his $200 wages, which pushes it below zero. So the effective threshold for his self-employment income becomes $0.
Zero. So he pays tax on all of it.
Exactly. He owes the 0.9% tax on his entire $150,000 of self-employment income, plus the tax on the $75,000 of his wages we already mentioned. Don definitely needs to file Form 8959. His case shows how both income types can be taxed and how that self-employment threshold can vanish completely.
That's a really substantial hit. Okay, what about a joint filing couple?
Good one. Let's take Aaron and Frank. They're married, filing jointly. Aaron earns $150,000 in wages. Frank earns $175,000 in wages. Individually, neither is over $200, so no employer withholding happened for either of them. But their joint threshold is $250,000. Their combined wages are $150,000 plus $175,000, which equals $325,000.
Which is over the $250K threshold.
Precisely. So they owe the additional Medicare tax on the amount over the threshold. That's $325,000 minus $250,000, which is $75,000. They need to file Form 8959. It really underscores why joint filers have to look at the combined income.
Okay, and maybe one more to show that RRTA separation.
Yes, let's look at George and Helen. Married filing jointly again. George has $190,000 in wages. Helen has $150,000 in RRTA compensation. Neither hit $250K individually, so no withholding. Their joint threshold is $250,000. Now, here's the key. Do they combine the $190K wages and the $150K RRTA compensation to check against the $250K threshold?
Based on what you said earlier.
Correct. You don't combine regular wages and RRTA compensation for this purpose. You look at them separately against the threshold. George's wages, $190K, are below the $250K joint threshold. Helen's RRTA compensation, $150K, is also below the $250K joint threshold. So neither of them owes the additional Medicare tax. They don't need to file Form 8959. This example clearly shows that RRTA income stands apart. And just quickly, another example, Ishmael and Judy filing jointly. Ishmael has $160K self-employment income. Judy has $140K RRTA income. Again, neither is over $200. And Judy's RRTA income does not reduce the threshold for Ishmael's self-employment income. Since neither income type exceeds the $250 joint threshold on its own, they don't owe the tax.
Those examples really drive home the different rules. Okay, so putting this all together, what does this mean for planning ahead? If you think you might owe this tax next year, what should you do?
Good question. If you anticipate owing additional Medicare tax, say for 2025, and you know your employer's withholding won't be enough, maybe because of that self-employment income, or multiple jobs below the $200K trigger, you've got a couple of main options. One option is to adjust your W-4 form with your employer. You can ask them to withhold additional income tax each paycheck.
Just regular income tax, not specifically AMT.
Right. You can't designate extra withholding just for additional Medicare tax. It just gets lumped in with your overall federal income tax withholding. But increasing that can help cover the expected AMT liability. The other main option, especially relevant if you have significant self-employment income, is to make estimated tax payments. You'd pay these quarterly throughout the year. This is really important because if you just wait until you file your return to pay the AMT you owe, you could get hit with an underpayment penalty.
Ah, the estimated tax penalty.
Yeah, exactly. You figure that penalty using Form 2210. So making those estimated payments if needed is the way to avoid that particular sting. Planning ahead is key.
And what if you make a mistake? Or, say, you get a corrected W-2 later that changes your income numbers.
If any of your relevant income figures change, Medicare wages, RRTA pay, self-employment income, you might need to adjust your additional Medicare tax calculation. If that happened, you'd file a corrected Form 8959. You attach it either to your original tax return if you catch it in time, or to an amended return, Form 1040X, if you've already filed. And if the correction relates to wages or RTA pay, you'll also want to attach the corrected Form W-2C or related documentation. One last point, specifically about tips. The IRS is quite clear here. If you have tips that you're required to report to your employer but didn't, you could face a pretty steep penalty. It's equal to 50%, half of the Social Security, Medicare, and the additional Medicare taxes that are due on those unreported tips.
Ouch, 50%.
Yeah. You could potentially avoid it if you can show there was a reasonable cause, and it wasn't willful neglect, but it's definitely something to be aware of. Report those tips accurately. And then, when all is said and done, your completed Form 8959 gets attached to your main tax return. Your Form 1040, 1040-SR, 1040-NR, or 1040-SS, it becomes part of your complete filing package.
Wow. Okay. That was definitely a deep dive. We've really unpacked that 0.9% additional Medicare tax. We covered the thresholds, which depend heavily on your filing status. We looked at when withholding happens, but maybe more importantly, when it doesn't happen and you need to be proactive. And those examples really highlighted the sometimes tricky interactions between wages, self-employment income, and RRTA compensation, what gets combined, what doesn't, and that crucial threshold reduction rule.
Absolutely. And it really leads to that final thought, circling back to something we touched on earlier. Since these income thresholds, the $250K, the $200, the $125K, aren't indexed for inflation, what does that really mean for your financial picture maybe 5-10 years down the line? If your income grows, even just steadily, how might that non-adjusting threshold impact your tax liability over time, especially if you have multiple income streams? It's certainly something worth mulling over as you do your long-term planning.
A very important point indeed, something for all of you to think about. Well, thank you for joining us on this deep dive into the additional Medicare tax. We certainly hope you feel more informed and prepared now. Until next time, keep learning.